Welcome to Claritas Module 3. We've got 3 chapters, 2 modules out of the way so far. They are relatively short and sweet, though there's still quite a lot of terminology to get to grips with. What we're doing in modules 3 and 4 is, for most people, the biggest chunk. Although it's 20% for each of modules 3 and 4, I would expect that for many of you, if you don't have some form of financial background, this is going to take up a lot more than 20% each of your time. So 3 and 4 may well be the majority of the work you put in. For Module 3, we have 5 chapters. We're going to start with financial statements, then look at quantitative techniques, and move into economic ideas. And these 5 chapters are all within 20%. So, frustratingly, if you've never done anything accounting before, this chapter we're going to do, which is pretty detailed, is only for 4% of the curriculum. Now, don't be disheartened. A lot of questions are going to be very straightforward, asking for basic definitions, where you'd find certain items in accounts, how certain things affect the accounts. So as you're following your way through this, you are not trying to become accounting analysts. You're not having to do very detailed analysis. You need to know very roughly where the numbers go, very roughly what sort of things some of the figures are telling us. So let's launch into Chapter 4. Learning outcome statements. The 3 statements we're going to be looking at: income statement, balance sheet, cash flow statement. On the balance sheet, we're going to define assets, liabilities, and equity, and the link between the 3 statements. We'll look at profit and cash flow and see how they differ. We'll look at the different classifications of cash flows. We can have cash flows from operations, investments, and financing activities, and we'll define those 3 and how we can calculate them. A couple of ratios as well, and a bit of interpretation of ratios. Lots to get through. We're now going to look at the 3 primary financial statements. So when you get the financial statements, you're going to see 3 statements: the balance sheet, the income statement, and the statement of cash flows. The balance sheet is probably the most important of them. Certainly analysts tend to spend more time on that than the others. And the balance sheet says what is the status on a particular date. It is a snapshot view on the year-end date. So if a company is putting together accounts for one particular year, then this will be the 31st of December of that year. At the year-end, what does the company own? What does the company owe? What is what's called the net worth of the company? Now, broken down into 3 groups. We have assets, liabilities, and equity. The assets are all the positive things that are going to bring value to the company. Now, I don't need to write these down because you'll see an example in a few pages, but you've got things like cash sitting in the bank. That's obviously as good value as you can get. You've got, I mentioned the 100 customers that owed us $1,000, so you've got your what are called accounts receivable, people that owe us money. We've got stock sitting in the warehouse. That's called inventory. Stuff ready to sell. That's hopefully going to bring us value when we do sell it. You've got the plant and equipment. You've got properties. You've got even intangible assets. Think about intangibles. A company may own a brand or a patent or a trademark or a license. Although it's not tangible, you can't sort of hit it. It's certainly something that will bring value to the company in the future. So they're all the assets. Liabilities are all the negative things. So the company owes other people money. There could be a bank overdraft. There could be a bank loan, a longer-term loan. There could be, we've got what are called the accounts payable. So this is money owed to suppliers. We've bought some stuff that's now sitting in inventory, but we haven't yet paid for it. And so that's an account payable. You've got other things in there, but we'll talk in the next section about bonds. If a company issues a bond, borrows money from the market, then that is a liability because they're going to have to pay it back. Think of a liability as something that someone else is claiming from the company and that the company is going to have to pay back at some point in the future. And then finally, equity. Equity is defined as assets minus liabilities. In other words, the balance sheet must balance. Assets equals liabilities plus equity. And this is called the fundamental accounting equation, and you really do need to know that very well. But the way this diagram works is we use this diagram a lot. I mean, you'll see it a little bit as we work our way through this, but if you sort of move into more advanced financial exams, if you start, for example, doing CFA after you've done Claritas, you'll see we use this diagram very extensively. You don't see it so much in the textbooks, but the reason we use it is because it's such a simple graphic way of explaining how transactions work, how they affect the status of the company. And so, coming back to the equation, because assets equals liabilities plus equity, we can say that equity equals assets minus liabilities. So assets are all the positive things the company owns, liabilities are all the negative things the company owes other people, and equity is the difference, which is therefore the net worth. Imagine you bought a $400,000 property, and imagine you took out a $300,000 mortgage. So what you have an asset worth 400,000. You have a loan that you owe the bank of 300,000, and therefore the amount that you put in at the beginning, and to be honest, the amount that you would be able to walk away with if you were to sell it, would be 100. And so that's called the equity. When you talk about you owning equity in a property, that's how we do the calculation. It's the value of the asset minus the value of the liability. There we go, there's your house. So that's what we're going to be dealing with. When we're buying shares in a company, it's equity. So the ownership of the company is the equity side. So that's the balance sheet. We'll see much more of this as we work our way through the chapter. Second, the income statement. The income statement represents the timeline through the year. So whereas the balance sheet was a snapshot, the income statement is the movie. So this is saying what are the transactions during the year. And the way this is structured is you start off with what we hope is the biggest number, which is revenues, also known as sales. It's also known as turnover, but revenues and sales are very interchangeable. So they all mean the same thing. And that is the total value of all sales to customers. So we've sold, let's say we sell widgets. Here we go. Here's our widget. It may look like a remote control to you, but this is our business. We sell these for $50, and we sold 1 million of them last year. So revenues we will show as 50 million. Now, one thing that's important is what we call accruals, or the accrual concept. And the accrual concept says that, I mean, we're going to come across various examples of this in the chapter. The accrual concept says we are matching transactions to the appropriate time periods. So, for example, if we made, let's say last year we had our year from January to December, let's say in December we sold 1,000 of these widgets to a customer for $50,000. But we gave them a month's credit because we're nice. And so we gave them a month's credit, 31st of December, they haven't paid us yet. So in December, we made the sale of $50,000, so 1,000 widgets for $50, and the revenue for that year will show $50,000 for that sale because a transaction accrued on that date. That's when we shipped them out to the warehouse. That's when they committed to making payment. Now, they didn't actually make the payment until a month later, in January, and that is demonstrating the accrual concept, that the income statement shows the transactions in the period that they are allocated, not when cash was received. So in that situation, last year's December saw the revenue, and that will be shown in last year's income statement. It'll also be in the next year's cash flow statement, because which shows money coming in and money going out. So the income statement does not look at cash. It looks at when the transaction happened. So we sold 1,000 widgets. They generated 50,000 in revenues, and that's going to be there in the income statement as revenues, even if we haven't been paid. On the assumption we are going to be paid, that's not a problem. Cost of sales. Now, we sell these widgets for $50. but it only costs us $30 to make them. So let's put in, just all in millions here, let's put in some numbers here. You don't need to copy this in, just purely for explanation. So there was 50. Let's say these cost us $30 to make. Now, that 30 includes the bits of plastic, nuts and bolts inside, a bit of machinery, so lots, not the machinery, but a bit of workforce. So all the effort involved in making these, the direct effort involved in making these, is $30 a go. And so that means if we sold a million of them, and so we've made revenues of 50 million, our cost of those sales was 30 million. So 30 times a million. Once again, accruals. We may have made a purchase of goods that we then sold in December, and so some of the December sales may have been part of something we'd bought in December, but not yet paid for. And so the cash going out to the supplier isn't till next year. That's fine. It's still part of this year's income statement because of the accrual concept. So the accruals say that revenues attributable to this year, so sales made this year, regardless of when we got the cash, are shown. Our cost of those sales that we made, regardless of when we paid for them, are also shown in the year. So the accrual concept says we allocate transactions to the appropriate time period. That gives us gross profit. Here you can see it's 20 million. You then subtract all the other operating expenses. What are operating expenses? They are effectively all the costs that you see if you look through the factory window. So all the costs of wages and salaries, all the costs of the maintaining the equipment, all the costs of running the machines, utilities, and everything else in terms of keeping the business on its feet. Part of operating expenses, just to make a point, because we're going to see this term later, that includes depreciation. Now, I've already given an example of this, and that is we had our $1,000 machine, and we said, if we think it's going to last 2 years, you split the cost into 500, 500. That's called depreciation, because 500 a year, the value of the machine drops. It started at 1,000, dropped to 500 after the first year, dropped to 0 after the second year. If we say it's going to be 4 years, then the depreciation expense is 250 a year for 4 years. We're spreading out the 1,000 over 4 separate years. And so the depreciation expense we'll see is that the machine will drop gradually over 4 years to 0, and the depreciation expense is how we spread that 1,000 out over the 4 years. So that's part of operating expenses. That gives us operating income. The word income in finance tends to mean profit, not sales. So income is what's left. I know you may think of your personal income as the salary you receive before you start paying for all the things you buy during the month. But in corporate terms, income means after expenses, so it's profit rather than revenues. So operating income means what is the profit after paying all the operational costs. And if you like, quite a useful thing to do is to think of the top half as the business or the operations. So this is the functioning of the company. And that takes us down to operating income, also known as EBIT. EBIT is earnings. Again, earnings is another word for income. It's a profit figure. Earnings before interest and tax. Now, if you look at the structure of the income statement, you can see it's before interest and tax because they're further down. And so this is what the business is doing. Then, if the company had borrowed money during the year, they've got to pay some interest. That gets taken off. If the company has any profit left, this is called EBT, earnings before tax, also known as pre-tax earnings. That is taxable. The government wants their stake, and so they get their claim, and what's left is called net income, or earnings after tax, EAT. So net income is the more common expression. And if you like, the bottom bit is the financing. So you can always break the income statement down into two groups. You've got the operational half and you've got the financing half. The financing is dependent on how the structure is the structure of the business. You don't see that looking through the factory window. You need to look in the company ledgers for that. But the business side is what you see through the factory window. And that's how the income statement works. What happens to net income? Let's just think about net income for a second. Who owns that? Well, it's owned by the owners of the company, the shareholders. Now, shareholders want to receive, for many companies, if you've made a profit, shareholders want to receive a bit of the profit themselves in the form of dividends. And so the net income is what is available after all expenses from which to pay the shareholders. Now, companies are not going to pay all of that to shareholders because they need to keep a bit back for emergencies. They need to grow even through inflation. If they need to buy new, bigger machines, every time, if a company's got lots of different machines in the factory, every year a few of them are going to need replacing. So it needs to keep back a certain amount of cash. But on what you've got here is some of this goes as dividends and some of it is retained. So it's retained in the business, and the proportion that's paid out entirely depends on the company management, depends on the policy. But most companies try and pay a pretty steady dividend, so growing it a little bit each year, so that the shareholders know they're going to receive a steady amount of income. And if a company is paying a steady dividend, that's going to help the stock market find an appropriate value for the company. So they'll normally pay out a reasonably steady dividend, and they will retain the rest. They're not going to pay out all the net income because otherwise they don't have any more money left to grow, so they can't grow at all. And some companies, certainly younger companies, don't pay out any dividends. They retain everything because while they're growing rapidly, they're going to say, well, look, we want to buy this new machine. We want to build a new branch somewhere, and we're not going to pay the money out to shareholders yet. As we grow now, then we're going to be building up our reserves. I think companies like Amazon, where they've got massive infrastructure, massively growing, they don't pay any dividends because they're reinvesting all the time. And one day when they feel that they're the size they want to be, however big that happens to be, they will start paying potentially quite large amounts of money out to the shareholders. So that's the income statement. The key word of the day is accruals. Here's our balance sheet. We have assets, liabilities, and equity. Here's our income statement. And at the bottom of the income statement, we have net income. Now, the net income, some of it's paid out as dividends, as we've seen, so that goes out as dividends. The rest of it, I said, was retained. Now, when it's retained, what happens to it? Well, it actually gets put on the balance sheet. So we've made a profit in the year, and it goes into equity. Imagine you're a shareholder. Then you own a company that's made profit. So the balance sheet value, what's called the equity, will grow. In other words, you've got more cash in the bank. Think of the balancing side of this. Cash has gone up. Let's say in the year we've been very profitable. Cash has gone up, and equity goes up, and it'll go up by an equal amount to match. And so that's retained. And on the balance sheet, in here, we're going to have an account. It's called retained earnings. And it adds up every year's profits that haven't been paid out. And so if the company has a big history of profitable trading, then the equity on the balance sheet will be very big, and that makes the shareholders' value much more. Now let me just show you how this transaction works. We've paid $60,000, and I'm going to show you all of this on the balance sheet. So there's a dollar sign. That just means cash. It's my shorthand for cash. And that goes down by 60. And so if you look at the balance sheet, had we not done this rental transaction, we'd have 60,000 more in the bank. But you've paid 60,000. We have used up 45,000. And what this means is we had the rental expense in the income statement of 45. That means that feeds through the income statement. We've reduced profit by 45. We've reduced retained earnings by 45. In other words, as a shareholder, you're 45 worse off because you've used up 45 of rent. But you've also got this prepayment. And remember, I described that as an asset because we own basically 3 months of office rent. And so that's called a prepayment. And that's going to go up by 15. And so on total assets, you see assets have gone down by 60 and up by 15. Overall down 45. Liabilities aren't affected. and equity down 45. Now, I'm just showing this as an example of how we use the balance sheet. If that was a bit confusing, don't worry about it, because you don't need to do this level of detail. But you can see the benefit of the diagram, hopefully, in that the balance sheet has continued to balance. That on the balance sheet, we're showing that cash has fallen by 60. That matches the cash flow statement. You can see that earnings have fallen by 45, and so shareholders have lost that 45 of value. And you can see that we have this prepayment of 15. We have this 15 asset that's going to give us office usage for the next 3 months. And overall, the balance sheet continues to balance. In every transaction that you will ever see throughout your career, I guarantee the balance sheet will always balance, because that's how it's defined.